Reserve Bank has announced monetary policy which cut repo rate by 25 basis but did not change its stance. We have been discussing with Dinesh Kumar Khara of SBI, Rajiv Anand of Axis Bank, Prasanna of ICICI and Pranjul Bhandari of HSBC, the nuances of this policy. Well, my trouble is that, Pranjul, starting from last August, when inflation fell below 4% at the headline level, the repo rate at that time was 6.5%. Starting from there, the real repo, ex post, the positive real rate has been almost 300 basis points almost throughout, and sometimes even going towards 400. Has the time come for the Reserve Bank to, and the MPC, to shed some of its caution? Is it overcautious and, ensure that through liquidity and rate cuts, it ensures better transmission? Is this caution warranted?
Well, look, I take your point that inflation has been low for far too long, below target. And that's exactly the reason why we have another rate cut in our forecast for June, or if not June, then in August. But anything more than that will be risky at this point. And there are two good reasons for that. If you look at headline growth, headline inflation right now, both the numbers are very low. But our forecasts at this point seem to suggest that they'll go back up. Growth is below 7%, but after elections, we always see that, private sector spending comes back up as political uncertainty fades and growth picks back up pretty quickly. So I think that could change. Growth could easily go back to the 7% plus range. In terms of inflation, it's right now very low, under 4, but by March 2020, we expect it to go back up to 4%. Not much higher than 4, but at the 4% target. So that doesn't leave too much space for a lot of easing. The second is, look at things right now. Headline growth, headline inflation look very low, but that's just headline. If you look at the underlying momentum, things are not that bad. Core GVA actually rose in the December quarter sequentially and also on a year-on-year basis. Also, core CPI at this point is elevated at a plus 6%. So the underlying pressures from growth and inflation are not as soft as the headline numbers suggest. So for all of these reasons, I think some caution is warranted.
Okay. Well, I accept some caution. Maybe it is overcautious. Looking back at the way inflation trajectory has come about. Mr. Khara, I wanted to try and squeeze in just one question on the February 12th circular as well. It's going to be replaced. What would you like in it? Surely they will drop the reference to compulsorily taking accounts to IBC because that's the court's verdict. But will you want anything else rejigged, one-day default or anything else?
No, I think the February 12th circular, of course, we are expecting some kind of a redrafting of the circular. That is something which we are expecting. But when it comes to ability of the bank to go to NCLT or expedite the resolution process, I think about a year plus has gone and banks had started looking at this as an opportunity for resolution of its impaired assets. So I think February 12th circular, of course, will enable the banks to really take that decision. Actually, what really happens is that many of the banks, since in the consortium, there is a play of many banks. So some kind of a overarching guidance from RBI helps in ensuring that there is a convergence of viewpoint for taking the account to a resolution process.
Saying that 66% should be written into the circular.
In the new circular which
Mr.
comes
Khara,
in.
Should that 66% vote is enough?
I think something like that, which we have actually put in the intercreditor agreement, which actually permits us to do that. If that is incorporated into the circular, that will probably bring in enough discipline among the consortium members and also will steer them in the right direction also.
Okay. Rajiv, if you want to comment on that, how anything that you all would want tweaked, because the circular is anyway going to be written up again. But more importantly, now you have 2 percentage points more of your deposits which you can lend. What is your outlook on loan growth as well?
I think on the first question, you remember that the Supreme Court has already validated the whole the whole structure of the IBC, all that has happened in the last Supreme Court judgment is that this whole issue of forcing companies to NCLT has in a sense been deemed ultra vires. But that does not stop banks voluntarily taking companies to NCLT, and I'm sure that the new RBI circular, as and when it comes up, will just sort of reinforce this in a manner that meets the legal requirements. Secondly, as far as
loan growth,
a better situation on LCR, our own estimate is that LCR in general over a period of time will improve by about 12%, which is quite significant. And ultimately, I think if you're not going to buy, if there is less requirement to buy SLR, by definition, that money should go into productive lending, and that's really what banks like us will do, who have the capital to be able to do so.
So loan growth in the system improves, you think?
Yes, I think so.
Okay. Well,
I think the constraint, what we've been talking about so far, the constraint to loan growth is deposit growth. And I think we've got to spend a little more time in terms of understanding why deposit growth is not happening. And I think one is household savings are not growing fast enough. Two, in that environment, there is various pulls and pressures in terms of where this money is going into, small savings and so on and so forth. And I think until we get deposit growth growing, I think it will be difficult, and it will act as a binding constraint to credit growth as we go forward. And I think hopefully the world is going to look much brighter on the other side of elections.
Okay.
And as private capex begins to kick in,
okay,
getting deposit growth going is an imperative.
Let me see if I can get the other bankers also to take a shy at this. But Prasanna, I wanted to wind up to say, how will you see yields move from here on? The LCR thing is actually bond negative because you guys are going to buy fewer bonds. And yet there is a very good, probability of inflation falling according to the Reserve Bank's own estimates. And probably, deft use of liquidity, dollar swaps as well as OMO. What is your best guess of where the yield can go by, say, May 31st, June 30th, even September 30th?
So I'm not going to give you a number for those dates, but I'll just give you a general direction in which possibly the markets will be moving. Right now, actually, as we spoke in the second half of the day, markets were busy unwinding all the expectations that they took into the policy. And as a result, the 10-year yields went up, the corporate bond yields went up, and so on and so forth. So as we go forward, I mean, yes, I do agree that inflation is going to be quite benign going forward. So there are expectations still, residual expectations that there could be one more rate cut somewhere maybe in the month of June or in the policy after June. But for that, I think a lot of uncertainties in the upside risk which RBI had mentioned should actually come through. Like, for example, oil price need to remain where it is. Then you need to have food price inflation not really going back as much as to disturb the expectations of headline inflation crossing 4% by end of the year. So for having said all this, I think the next rate cut is not ruled out. So I would basically say that there is, yes, definitely a possibility of a probability or a possibility of one more rate cut coming in. Okay. But what is also happening is that the government borrowing program is going to start and all earnest from Friday. And so the last 4 or 5 days was possibly the best part of this month when actually you had a forward-looking RBI policy with the rate cut. But then after that, you have all the borrowing program kicking in. So again, the same story is going to play out. We are going to see a yield curve which is going to steepen. We are going to see the short end which is going to be well supported because of the fact that the funding rate has actually gone even lower. But on the other hand, the long end is possibly going to sell off a little to anticipate for preparing for the fresh supply which comes in from the government bond market. And on the corporate bond side, like you rightly said, since the hedging cost has come down because of the buy-sell swap announced by RBI first time around and now the second time around, I think the view on the spreads is a little bit more benign. I mean, at the end of the day, if GSEC yields are going to go up in the long end, it's very difficult for corporate bond long end to come, yields to come down. So I would again expect some kind of a steepening happening on the corporate bond curve as well.
Okay. So we are not going towards 7% for the 10-year.
No, I would put the new 10-year range to be in the region of 7.25 to 7.5.
Okay. Well, then there isn't much transmission through the bond markets or through the bank market. Well, actually, I guess the heart of the problem really is that for the lower middle class depositor, the competition from the post office savings rate and the other small savings rate is too compelling, and he doesn't bring the deposit to the bank. And for the slightly more evolved saver, the money market mutual funds are giving a better return than the deposits, and therefore deposit rates have to go up before they come down. It looks like transmission is not round the corner. Money is not getting cheap, despite the fact that we have got inflation straddling 2% for a goodish bit. This assessment of savings requires more time, but you all have enriched the discussion. Pranjul, Mr. Khara, Prasanna and Rajiv Anand, thank you very much for giving us the many-sided, many facets of the monetary policy and the state of the economy. Thank you very much for joining.